everyone. My name is Pat Somerville, Senior Partner and Head of Business Development here at Hamilton ETFs. I'm joined by Nick Picard, our Chief Options Strategist and Lead PM on our popular YIELD MAXIMIZER suite of ETFs. Several weeks ago, we launched the Hamilton U.S. Bond YIELD MAXIMIZER ETF, which is Canada's first covered call fixed income ETF, which we're quite proud of. We've been going across the country having many conversations with investors and advisors, and we wanted to have Nick here to talk about some of the most frequently asked questions that have come up. So welcome, Nick. Thank you for your time.
Thank you, Pat. Great to be here.
So one of the most common questions that's been coming up in our conversations is really centered around how are you able to do this? This has been a very common strategy for income investors for a long period of time, but this is the first on the fixed income side. So how are we able to do this now versus 5 years ago?
A lot of people look at this product and like, wow, covered calls have been around on the equity side for over 20 years and over 10 years in ETFs. Why covered call on bonds right now? And there's a couple reasons for that, Pat. The first reason is just the bond ETF market has grown so much. 10 years ago, it was a much smaller market with much less liquidity. We didn't have the options liquidity to do a strategy like the ones we're doing right now. And the other reason is the volatility in the fixed income market. For a long, long time after the global financial crisis, we had very low fixed income volatility because of the Federal Reserve doing quantitative easing. Now that we're in a more normal rate environment, we're getting a lot more volatility, and this strategy makes a lot of sense.
That's great, Nick, and very helpful, and great to know how investors can take advantage of some of these changes and bring some of the benefits of covered calls over to the fixed income side of their portfolios. So the next question we've been getting a lot of really centers around the bond market, which has been a tough place to be the last few years. So I thought it'd be good if you could add some comments on our views and if you think this is a good buying opportunity for people looking at H bond.
And it has been a very tough bond environment indeed. Since the beginning of the U.S. Treasury, this is probably one of the largest drawdowns in the bond market that we've seen. As of today, with the bond market again down this year, this will be the third consecutive down year for the bond market, something that we haven't seen in over 100 years. And so, it's fair to say that many investors are quite concerned about the bond market. But if you look at the big picture environment, the 10-year yield is now over 4.5%. And if you go back 150 years in terms of historical 10-year yields, that's about a normal rate environment. And so I think in the environment that we're in today, with an aging demographic, bonds are still going to be an essential part of a diversified portfolio. And what I like about the covered call strategy is that we can take advantage of the volatility that we're seeing today to enhance your yield.
So on the topic of yield, Nick, I would say one of the most common questions we've been getting is how is it able to pay a 10% distribution yield, and is that sustainable?
Absolutely. And if you look at the portfolio, we have a portfolio of bond ETFs from short-term to long-term, and just that portfolio alone yields about 4% of income. So we only need to get an extra 6% from the covered call strategy to get that 10% plus yield that we're targeting. And if you look at the volatility environment today, it's actually fairly easy to get that 6% yield with the options market today. But even going back historically, and we have done some testing going back in different rate environments, and even with a 50% call writing strategy on half the portfolio, we were able to get that 10% plus yield.
That's great. And I think we should talk a bit about the tax efficiency. So in Canada, covered call premium income is generally taxed as capital gains. So I think that's just a good point to bring up with our investors that may not be known, is that a big part of the dividend for H bond will be tax efficient, generated by the premium income that Nick and his team are running. So Nick, you talk about how you're writing options on 50% of the portfolio. Can you talk about why that number, why 50%, and if that coverage ratio can fluctuate?
Yeah, we wanted to be consistent with the approach that we've been using on all our covered call ETFs. And that is an approach that focused on income, but with a balance so that you can still benefit from the appreciation of the underlying portfolio. And that's exactly what we do with H bond. We have a portfolio of bond ETFs, and half of the portfolio is on long bond ETFs that we can use for the covered call strategy.
So the follow-up question to that is that we've been getting a lot from advisors is, can that coverage ratio fluctuate? Under what market conditions will we see that coverage ratio change or vary?
Yeah, absolutely. That coverage ratio can change depending on the volatility environment. For example, in the higher volatility environment that we're in now, we don't need to write 50% of the options on the portfolio to achieve the yields that we need to get a 10% yield. So that can fluctuate depending on the volatility environment that we're in.
So, Nick, many advisors have been correctly pointing out that there's never a free lunch. They see a 10% yield and want to know what's the catch. What are they giving up in order to get the 10% yield?
Well, H bond is no different than any other cover call strategy. And so when we write on half of the portfolio, we're giving up the upside on half the portfolio. And so we still get the full upside on the portfolio that we're not written on, and that's 50%. And that's going to be a mixture of short, medium, and long-term bonds. But on the 50% that we're writing cover call options on, you forego that upside in exchange for additional yield today.
So, Nick, let's bring the conversation to risk. When evaluating any type of investment, it's important to look at the risk of the underlying. And typically with bonds, to receive a higher yield than you would otherwise, it implies that you're taking on some more risk. So can you talk about the risk profile of H bond for our investors?
Yeah, absolutely, Pat. And traditionally, bond investors have usually had to take extra credit risk or extra duration risk to get the yields that they're looking for. What's nice about H bond is absolutely you are taking a little bit more duration risk because that's where the volatility happens, but you're able to reduce some of that volatility by selling the cover calls and generating that extra premium. The one thing I would say about H bond is that we own bonds that represent the entire yield curve. So we have some short-term bonds, we have some medium-term bonds, and we have some long-term bonds. Now, absolutely, the focus of the portfolio is on the long term. That represents kind of 80% of the portfolio. But we do have these shorter maturities that reduce some of that risk.
So, Nick, in a lot of the conversations we've been having with advisors, one thing that's becoming very clear is that their fixed income allocations are definitely going up in this environment. So can you comment a little bit on where H bond could fit within a fixed income portfolio and what are some of the benefits of the fund?
Yeah, certainly, Pat. And just like our equity cover call ETFs, which you can use as a yield enhancement tool, H bond is the same in the sense that you can use H bond in the fixed income side of your portfolio to enhance the yield. And a small allocation to H bond can have a significant impact on the overall yield of the fixed income side of your portfolio. Now, it's not meant to be the entire allocation. You only need to use a modest amount to make a big difference. But what we need to address here as well is the tax efficiency of H bond in the sense that because the call premiums are capital gains, you're getting a mixture of income and capital gains as part of your distributions. So, in summary, H bond provides higher tax efficient yield without taking any additional credit risk.
That's great, Nick. Thank you for your time, and thank you to everyone for listening in. We hope you found this to be valuable and informative. If you want additional information on H bond and our suite of Yield Maximizer ETFs, please visit our website at hamiltonetfs.com.